Today, we are going to take a look at how to add to your position. When you are in a trade, how can you make that trade bigger as that trade continues? Now, a lot of traders do it the opposite way. They do what I feel is backwards. You get into a trade, the market moves in your direction, and at some point they take off half of their trade, half of their position size, or 80% of their position size, and they let the rest of that trade continue to hit your extended target or trail or whatever the case is. But they take off a bulk of their position size initially, and they let what's remaining left to go. Now, I don't do it this way. I do it backwards, maybe you'd want to call it. When I have a trade going, I get my entry, the market gets into the trade, continues to a certain level, I'm going to add to that trade. I'm going to take a second position. I'm going to make a second trade, and I'm going to let both of those trades get up and hit my target. Now, we can do this 3 or 4 times even. The most common is adding a second position to your trade, letting 2 trades go to the same target. Now, there's nothing mystical about adding to your trade. Adding to your trade, adding to your position simply means placing a second or a third trade. So you've got trade number 1, that is the initial trade. The market moves in your favor, and then you add a second one. You've got your second buy trade. So now you've got 2 trades that are going in your favor. Now, when it comes to adding to your trade or adding to your position, a lot of people get confused with the stop losses. So what I want to do is show you what I would consider the proper way to add to your position, the proper way to make use of the market movement, and how to not take on any additional risk. When you put on a trade that's worth 2%, the last thing I want to do is potentially lose more than 2%. And I can still avoid that even if I add to my position. I could take my initial position for 2%. I could place another trade that is also for 2%. I could even place a third trade that risks 2%. And if the market does turn around and come back, I am only at most going to lose 2%. I am not going to lose that second 2%. I am not going to lose that initial 2%. The only 2% that I'm going to lose is that last one that I placed. I'll show you exactly how this works. Now, we've got an example on the chart right in the middle here where the market's moving up and we're looking to take on a couple of different trades. I'm going to place my initial trade to begin with. So first, let's scroll back a little bit and we'll look for a good target. Well, we'll go for this area right in here. How about? So we're going for a reasonable target, something that can be hit. Now, we've got the moving averages here. We're using simply the 8 and the 21. We get the crossover to the upside. Now we're looking for the market to move up, pull back, get us that signal, continue to move up, potentially make another pullback, give us another signal, and then continue to get to the target. This one is going to be for 2 trades. We're going to enter a first trade, and then we're going to enter a second trade. And that is what you're going to find is going to be normal. But sometimes you can enter a third or even a fourth one. We've done that in the Discord on more than one occasion. So the first trade is going to be right in here. And now our second trade is going to be right in here. So let's get the drawing tool out, our trade tool. And we're going to place our entry and our stop loss, and we're going to reach up for that target. Now, with that target, we're looking at a 3.7 to 1 reward to risk ratio. So we're going to potentially be getting just about 4 times what the risk is on this trade. Now, what's important is the market starts to move and then makes a pullback, and that pullback is going to be higher than that entry of that first trade. So we are going to place a second trade right here. So with that, I am going to take, again, my tool, and this is where the entry is going to be, and the stop loss is going to be under that candle, and we'll be aiming for the same target. Now, what's important with this, what makes this work, is the stop loss of that second position has to be in profit. We are going to take the stop loss from that first position, so we have that initial stop loss of trade number 1. We are going to take that stop loss, and we are going to move it to the stop loss position of trade number 2. This means at trade number 2 here, we have 2 stop losses. We've got the first trade's stop loss and we've got the second trade's stop loss. So both stop losses are going to be at the same price. Now, as trade number 2 does carry on and move towards the target, both stop losses are going to be managed at the same place. Now, if we do this and the market does come back, we do get into the trade and it takes out out our stop loss. Not only will we have lost the 2% on that initial trade, but we'll have made some of that back. We'll have covered some of that. This isn't quite 2% right in here, but it is about 1.5%. So if we were to take this second trade, not only did we not risk 4%, we would actually only be down about 0.5% if this trade didn't work. So what we're doing is placing trade number one. We've got our stop loss underneath where we would generally put it. This trade moves in our favor. We place trade number two. The stop loss goes wherever trade number two would be. But the driving factor here, the most important key, is that stop loss number two is in profit. It is above the entry of trade number one. And then stop loss number one moves to wherever stop loss number two is. And now we've got two stop losses at the same place being managed the same way until that trade is closed. So let's take a look at this on a market that's moving down. So we're going to find that this is something that happens all the time, that you can take two positions in a trade. Here's one that has three positions, and it's going to be the same process. So let's get rid of all of these boxes. So we've got this set up on the 15-minute chart. So here we've got the trend turning down. We're looking for the pullback, and then we get that move back in the trending direction. Now, again, this is the 15-minute. So when we're looking at this, we're going to be preparing ourselves when the price has pulled back on the 15-minute. If I move this down to the 5-minute, let's just mark that off so I know exactly where that is. I want to be sure that I'm actually trading a system when we are using these examples, that they're not just random. So we've got this 5-minute time frame. Where can we target this? Well, we've got a nice target down here. We have an area of support, and we've seen it as resistance down here. This is a really strong area. Let's just pull it up just a little bit, make it a realistic target. And this is where we're going to target. So if I zoom in on this 5-minute, I will actually put this on replay. So let's go replay mode. Now we have a version that we can see in real time. So let's move this forward a little bit until we get our first signal. So we've got a pullback. This could indeed be the first signal. We've got the crossover happening right in here. So everything is down. We've got this market pulling back. We're going to place an entry just below that pullback candle, and that is going to go here. This is a good place for the stop loss. And let's see how far we can extend this target. So now we've got trade number one. Trade number one could be looking to give us just about 7-1. So let's now advance this forward, and we'll start to see if there's a second option in here. So we do have a second option. This is looking like it could be a good trade. We could place a trade underneath this one candle. We could place a second trade just under here. But the thing with this trade is if I place this second trade, my stop loss is going to be up here. And that stop loss is inside of that space where the stop loss is on the first trade. So if I were to lose this trade, I would lose more than that initial risk. So I'm not going to take this as a second trade because the stop loss is inside of this red zone in here. The only way I'm going to take a second trade is if we get a pullback, and that stop loss of the second trade is going to be in profit of that first trade. So let's get rid of the markings, and we'll continue to move this forward a little bit. So this is starting to look pretty nice. This could be the trade that we're looking for. So now we've got a second opportunity. We've got a short opportunity underneath this white candle. The stop loss is going to go above that white candle. And let's extend this down to the target. So right now we've got a second trade going where the stop loss is placed where you would place the stop loss for the second trade. Our stop loss is right here. But the stop loss from the first trade is now going to move to the stop loss for that second trade. Now, if we do get stopped out, the price moves away and then comes back and it takes us out, we're going to lose the 2% of this second position, but we'll keep the 3% that first position has locked in for us because of that movement of the stop loss. So if this does not work out, we'll be up 1%. And this is the secret behind how you add to your positions. So let's keep moving this forward. This could be another opportunity right here. So we have that third option to take a trade. That stop loss is going to be inside the stop window of that second trade. I do not want to take this trade. I am going to leave that one alone. So let's advance this a little bit more. Now there's an opportunity just in here. This is where the entry goes. This is where the stop loss goes. That stop loss is in profit of that second trade. So we've got all of this as profit from the first trade, and we've got this as profit from the second trade. So if I place my entry order just underneath this one candle here, and my stop loss again goes above that candle, we're going to extend the target to the exact same target. So now we've got 3 trades looking for the same target. So we'll just extend these out just so that they're not overlapping. So now I've got 3 trades. First trade, stop loss was up here, has been moved to the position of the stop loss of the second trade, now has been moved to the position of the stop loss of that third trade. So the stop loss now of that first trade is in huge profit. We're looking at 4-to-1. The stop loss of that second trade is in some profit. We're looking at around 1-to-1. So we could be looking at a 5-to-1, but if we get stopped out, that'll be -2. So if we do get stopped out on this trade, we'd be in profit here, we'd be in profit here, and then we just lose this. So it'd give a little bit back. So regardless how this one works, we'd end up making money. So let's keep this going and see, maybe there's even a 4th position in here that we could take. And here we go. We took the profit target and we've got 3 different positions here. So with these 3 positions, we would have made a 2-to-1 return plus a 4-to-1 return. So we're looking at 6-to-1 plus we'll call this one a 7-to-1 return. So we're looking at a 13-to-1 return on what was initially a 7-to-1 return. So what we've got is a 7-to-1 trade that ends up being a 13-to-1 trade simply because we've added these positions. Now, by adding these positions, we were never at risk of losing more than our 2%. Now, with this trade, I did not scale out. I do not like to do that. If I'm in this trade and I have a good idea that the price is going to get to the target, I'm not going to play this to only get some of that profit. I want my money. If I'm going to get into this trade, I want this lot size to get me out in profit. So I'm not going to scale out here. I'm not going to scale out a little bit more here. I'm not going to scale out a little bit more here and just have a tiny little partial lot size hit my profit target. No, I'm going the opposite way. I'm going to add into the position. I'm going to add more into the position. I'm going to add even more into the position. And every time I'm adding a new trade, I'm reducing the risk of that first trade so that I can't lose any money on that first position, can't lose any money on the second, I can't lose any money on the third, as eventually this one does get managed. And if I do finally get my target hit, I am being hit with full wins. And to me, this is the purpose of adding to your position. It's not hard to do, and if you do it right, it's a safe thing to do. I hope you found this video useful. If you liked this video, please give it a like. And if you haven't subscribed yet, please do that as well. Now, we've got an Ultra Blue Forex Discord. This is for the members. And if you want to be part of that, the link is in the description below. And if I don't see you in that Ultra Blue Forex Discord, I will see you in the next video.